Welcome to our tax optimization guide. Did you know that the average American overpays their taxes by nearly $400 every year? That's money you could be keeping in your pocket. Shocking, right? And it gets better. Over 80% of taxpayers miss out on deductions and credits simply because they don't know they exist. Imagine what you could do with that extra cash. In this video, we'll reveal hidden tax deductions, show you how to maximize your refund, and share smart investment strategies to lower your tax bill. You'll learn the secrets of tax-efficient wealth building and get insider tips tailored for freelancers and small business owners. Ever heard of tax loss harvesting? Or how about the magic of 1031 exchanges in real estate? We've got that covered too. Plus, we'll give you last-minute year-end tax moves that can save you big bucks. Ready to take control of your taxes? Stick with us, and let's get started on optimizing your taxes this year. You won't believe how much you can save. Chapter 1, Tax Hacks 101, Discover Hidden Deductions. Welcome to Tax Hacks 101. Did you know there are tons of hidden deductions that people miss every year? It's true. According to the IRS, about 20% of taxpayers overpay because they don't know about these deductions. First off, let's talk about the home office deduction. If you work from home, you can deduct a portion of your home expenses. It's a simple way to save money. Just make sure your home office is used exclusively for work. Next, have you heard about the student loan interest deduction? Even if you don't itemize your taxes, you can deduct up to $2,500 of student loan interest. It's a small step, but it adds up. Medical expenses can also be a goldmine for deductions. If your medical expenses exceed 7.5% of your adjusted gross income, you can deduct them. This includes prescriptions, doctor visits, and even travel expenses for medical care. Another gem is the charitable contributions deduction. Whether it's cash or goods, keep those receipts. You can deduct contributions to qualifying organizations and reduce your taxable income. Did you know you can also deduct job search expenses? If you're looking for a job in the same field, you can deduct costs like resume preparation and travel for interviews. It's an often overlooked deduction. Education credits like the Lifetime Learning Credit can save you up to $2,000 per year. It's not just for full-time students, part-time learners can benefit too. It's a great incentive to keep learning. Here's a fun fact. You can deduct the cost of moving for a new job if it's at least 50 miles farther from your old home than your old job was. This deduction can cover moving expenses like truck rentals and storage. Remember, the key to uncovering these hidden deductions is keeping good records. Save your receipts, document your expenses, and stay organized. A little effort goes a long way. Chapter 2, Maximize Your Refund, Strategic Filing Tips. Ready to maximize your refund? Let's dive into some strategic filing tips that can put more money back in your pocket. First tip, adjust your withholding. If you're getting a huge refund every year, it means you're giving the government an interest-free loan. Adjust your W-4 form to increase your take-home pay instead. Next, consider filing electronically. The IRS reports that e-filing can lead to faster refunds. Plus, it reduces the chance of errors, which can delay your refund. Did you know that timing can affect your refund? If you can, defer income to the next tax year and accelerate deductions into the current year. This can reduce your taxable income and increase your refund. Another tip, take advantage of tax credits. Unlike deductions, which reduce your taxable income, credits reduce your tax bill dollar for dollar. Look into credits like the Earned Income Tax Credit and the Child Tax Credit. Here's a unique strategy. Contribute to an IRA before the tax filing deadline. Contributions can be tax deductible and lower your taxable income. Plus, it's a smart move for your future. Don't forget about the Health Savings Account, HSA. Contributions to an HSA are tax deductible, and withdrawals for medical expenses are tax-free. It's a triple tax advantage. Filing jointly with your spouse can sometimes increase your refund. But in certain situations, married filing separately might be more beneficial. Crunch the numbers or consult a tax professional to see what's best for you. Consider this: if you're a freelancer or have side income, pay quarterly estimated taxes. This prevents underpayment penalties and keeps your tax bill manageable. Lastly, always double-check your return for errors. Simple mistakes can cost you money and delay your refund. Use tax software or consult a tax professional to ensure accuracy. Chapter 3, Smart investments, tax-efficient wealth building. Now let's talk about smart investments. Building wealth is great, but doing it in a tax-efficient way is even better. One of the best strategies is to invest in tax-advantaged accounts like Roth IRAs and 401ks. Contributions to these accounts grow tax-free, and withdrawals in retirement are tax-free too. Have you heard of tax loss harvesting? This strategy involves selling investments at a loss to offset gains. It can reduce your taxable income and save you money. Municipal bonds are another great option. The interest earned from these bonds is usually exempt from federal and sometimes state taxes. They're a solid choice for tax-efficient income. Consider investing in index funds or ETFs. They're more tax-efficient than actively managed funds because they generate fewer capital gains. Less turnover means fewer taxable events. Did you know about the capital gains tax benefits of holding investments longer? If you hold an investment for more than a year, you'll pay long-term capital gains tax, which is lower than the short-term rate. Real estate can offer significant tax advantages too. Through depreciation, you can deduct a portion of the property's cost each year. Plus, you can defer taxes on capital gains with a 1031 exchange. Another strategy, contribute to a 529 plan for education savings. Contributions grow tax-free, and withdrawals for qualified education expenses are also tax-free. Here's a fun fact. The IRS allows you to gift up to $15,000 per year, per person, without incurring gift taxes. It's a good way to transfer wealth while minimizing tax implications. Finally, always stay informed about tax law changes. Tax policies can change, and staying updated ensures you're taking advantage of all available benefits. Consult a financial advisor to keep your strategies current. Chapter 4: The Power of Tax Credits. Boost your savings. Welcome back. Today, we're diving into the world of tax credits, which can significantly boost your savings. Unlike deductions, tax credits directly reduce the amount of tax you owe. First, let's talk about the Earned Income Tax Credit, EITC. This credit is designed to help low to moderate income workers. Depending on your income and family size, it can be worth up to $6,728. That's real money back in your pocket. Next up is the Child Tax Credit. For the 2023 tax year, it's worth up to $2,000 per qualifying child. The best part? Up to $1,400 of this credit is refundable, meaning you can get it even if you don't owe any taxes. Education-related credits like the American Opportunity Tax Credit, AOTC, can also save you a bundle. The AOTC offers up to $2,500 per eligible student, and 40% of it is refundable. It's perfect for those in their first 4 years of higher education. Don't forget about the Lifetime Learning Credit. Unlike the AOTC, this one isn't just for undergrads. It provides up to $2,000 per year for tuition and related expenses. It's great for anyone looking to improve their skills. Energy-efficient home improvements can also yield significant tax credits. The Residential Energy-Efficient Property Credit covers 26% of the cost for solar, wind, and geothermal systems. It's a win-win for your wallet and the planet. Did you know there's a credit for adopting a child? The Adoption Tax Credit can cover up to $14,440 of adoption expenses. It's a substantial benefit for growing families. Here's a unique credit: the Savers Credit. If you contribute to a retirement account, you might be eligible for this credit worth up to $1,000, $2,000 for married couples. It's an incentive to save for your future. Health insurance premiums can also provide savings through the Premium Tax Credit. If you bought health insurance through the health insurance marketplace, this credit can help cover the cost of premiums. Finally, always keep an eye out for state-specific credits. Many states offer additional tax credits that can further reduce your tax burden. It's worth checking your state's tax website for more information. Chapter 5: Small Business Edge. Optimize deductions and credits. Running a small business? Let's explore some strategies to optimize your deductions and credits, giving you the edge you need. First, keep meticulous records. The IRS requires proof for every deduction you claim. Save receipts, invoices, and any relevant documentation to avoid issues during an audit. Home office deduction is a big one for small business owners. If you have a dedicated space for your business, you can deduct a portion of your home expenses. This includes rent, mortgage interest, utilities, and more. Did you know you can deduct business-related meals? As of 2023, you can deduct 50% of the cost of meals if they are business-related. Keep detailed records of who you met with and the purpose of the meeting. Another key deduction is for business travel. Flights, hotels, and even rental cars used for business purposes are deductible. Just make sure you separate personal expenses from business ones. Office supplies and equipment are also deductible. From paper and pens to computers and printers, these everyday expenses can add up. Deducting them can lower your taxable income significantly. Health insurance premiums are another area where you can save. If you're self-employed, you can deduct the premiums you pay for yourself, your spouse, and your dependents. Vehicle expenses used for business can be a substantial deduction. You can choose between the standard mileage rate or actual expenses. Pick the method that gives you the biggest deduction. Don't forget about depreciation. If you purchase significant assets for your business, like machinery or vehicles, you can deduct the depreciation of these items over time. Here's a powerful credit: the Small Business Healthcare Tax Credit. If you provide health insurance to your employees, you might be eligible for this credit. It can cover up to 50% of premiums paid. Lastly, stay updated on tax laws. Tax regulations change, and staying informed ensures you're maximizing all available deductions and credits. Consulting with a tax professional can provide valuable insights. Chapter 6: Retirement Plans, Tax-Smart Savings. Let's dive into retirement plans and how they can help you save on taxes while securing your future. First up, the 401k plan. Contributions to a traditional 401k are made pre-tax, reducing your taxable income. For 2023, you can contribute up to $22,500, or $30,000 if you're 50 or older. That's a substantial tax break. Roth 401ks are another great option. While contributions are made with after-tax dollars, withdrawals in retirement are tax-free. It's a smart choice if you expect to be in a higher tax bracket later. Individual retirement accounts, IRAs, are also powerful tools. Contributions to a traditional IRA may be tax-deductible, depending on your income. For 2023, you can contribute up to $6,500, or $7,500 if you're 50 or older. Roth IRAs offer tax-free growth and tax-free withdrawals in retirement. While contributions are not tax-deductible, the long-term tax benefits can be significant. September IRAs are perfect for self-employed individuals and small business owners. You can contribute up to 25% of your net earnings, with a maximum of $66,000 for 2023. It's a hefty contribution limit with great tax benefits. Simple IRAs are another option for small businesses. Employees can contribute up to $15,500 in 2023, with an additional $3,500 catch-up contribution if they're 50 or older. Employers must match contributions, which are also deductible. Health savings accounts, HSAs, can double as retirement savings vehicles. Contributions are tax-deductible, grow tax-free, and withdrawals for medical expenses are tax-free. After age 65, withdrawals for any purpose are taxed like a traditional IRA. Here's a unique fact. Contributions to a retirement plan can also reduce your adjusted gross income, AGI, which may make you eligible for other tax credits and deductions. Lastly, consider a solo 401k if you're self-employed. You can contribute both as an employer and an employee, allowing for higher contribution limits. It's a powerful way to save for retirement and reduce your tax bill. Chapter 7: Real Estate ROI, Tax Benefits of Property Investments. Let's explore real estate and its tax perks. Real estate investments can offer some impressive tax benefits that can boost your ROI. First up, depreciation. Did you know you can deduct the cost of the property over 27.5 years for residential real estate? It's like getting a yearly bonus on your investment. Next, there's the mortgage interest deduction. For loans up to $750,000, you can deduct the interest paid on your mortgage. It's a great way to lower your taxable income. Property taxes are also deductible. This includes state and local property taxes, which can add up to significant savings each year. Have you heard of a 1031 exchange? This tax deferral strategy lets you swap one investment property for another without paying capital gains tax. It's a smart way to keep growing your investments tax-free. Another benefit is the deduction for repairs and maintenance. Any expenses incurred to keep your property in good condition are deductible. This includes things like fixing a leaky roof or repainting a room. Rental income is taxed at your ordinary income rate, but you can offset this with deductions for expenses like property management fees and advertising costs. Did you know you can also deduct travel expenses related to managing your properties? If you need to visit your property, the cost of travel can be deducted. Home office deduction isn't just for home-based businesses. If you manage your rental properties from home, you can deduct a portion of your home expenses. It's a nice bonus for landlords. Here's an interesting fact. If you sell your primary residence, you can exclude up to $250,000 of capital gains, $500,000 for married couples, from your income. This is a huge benefit if your property has appreciated in value. Real estate investment trusts, REITs, offer another way to invest in real estate without owning property. Dividends from REITs are taxed at a lower rate, making them an attractive option for investors.